We've also been watching what's been happening in Washington, D.C., legislators there trying to figure out what to do in terms of a response to coronavirus. At the same time, we've got some new data from China that presents a troubling picture. It just shows you exactly how troubling it can be when the economy kind of falls off a cliff. China's first quarter GDP plunging about 11%. For more on that, we're going to welcome Leland Miller. He's the CEO of Beige Book International, and he's been watching these numbers and is here to tell us about what it all means. Leland, good morning.
Good morning.
So what do you think? A drop of 11%, I guess it's not entirely surprising, given how China really clamped down and shut the economy down in response to coronavirus.
No, it shouldn't have been a surprise to anyone. But, even just a couple of weeks ago, you had the Reuters survey, the Bloomberg survey of economists saying that we're going to see positive growth for the quarter. So I think that there's a little bit of shock in the industry that things are this low. But again, it's not about first quarter weakness alone. The Chinese were going to acknowledge first quarter weakness to some extent because they shut down part of their economy. So you should have been expecting first quarter weakness. I don't think people were expecting double-digit weakness. And, when we work through our numbers, we're getting to a level of weakness we just never seen before. We're talking every sector weaker, every region weaker, every headline metric weaker, and not just weaker, but in contraction. So this is a new area. Uncharted waters. We've never seen anything like this before.
You think this is telling of what we can anticipate here in the United States, or was the shutdown here in the United States not as drastic? How should we be looking for lessons out of this?
Well, I think that's to be seen, depending on how long we shut things. There's a potential we shut things for much longer in the United States, depending on what the political decisions are around this. Now, keep in mind that the shutdown in the United States would be straddled between March and April and being two different quarters. And so maybe you see two quarters hit less so than one quarter mega hit. But either way, if we do have a widespread shutdown for an extended period of time, and that's looking more and more like it'll happen to some degree, you're going to have these extremely negative numbers. So again, the question is not how much the one quarter hit. It'll be how much can you recover. And the problem with China's position is that they were banking on having a weak Q1 and then exploding back to recovery. And that's not really possible considering the fact that every one of its trading partners around the world, most obviously the United States and Europe, are shutting down. And so they're going to have a very difficult time getting back up to growth with this type of broader international context.
You think if the rest of the world was doing okay, they'd be able to snap right back? It'd be a sharp upward spike?
I think it would be a lot easier to do so. I mean, the government has made clear that they're prioritizing growth and that they are going to get the economy back on track to try to meet Xi Jinping's growth targets for 2020. The problem is at this point, those growth targets are not possible. And they're not possible because no matter the level of domestic resilience that China itself has, there simply won't be enough external demand in order to be able to fuel that recovery. So the problem markets are going to have this quarter and the next quarter is understanding that, yes, China will be recovering, but they're going to be recovering from a severe contraction. And there's a very different outcomes for having that type of recovery where you're getting a better Q2 than Q1, but you're not getting anywhere near what the Chinese government has promised the recovery would look like. And that's going to be very, very incentivizing for Beijing to start juicing the numbers again to make the party's recovery look a little bit better.
So how transparent are the numbers of down 11%, and how will you go about measuring to see what the real recovery is?
Well, we asked thousands and thousands of businesses, and we've moved from doing this, 8 times a year to we're now putting out weekly updates on this. And so we're tracking this very, very closely. We're asking firms, are you back to work? The worst part of the story so far is that we saw firms overwhelmingly go back to work in March. But even for the first half of March, the numbers continued to get worse. So we were not seeing this recovery. We're not seeing this improvement in the first half of March. Now, I don't doubt that there's going to be a pickup the second half of March into April into May. But the problem is back to work doesn't mean back to growth. And so we're going to have to be watching.
Meaning
and the big question will,
Meaning that people went back to work, but there wasn't any demand and there were no sales?
Well, there may not have been demand. They may have just been turning their lights on and bringing their workers back, but even rolling the production machinery, but not producing anything. So there's a big political narrative that's screaming recovery, make the party look good. And as a result, there's a lot of motivation for it to look like they're back to producing when they're not yet back to producing. So we're not here to say that Q2 is going to look like Q1. Of course it's not. There will be a recovery. There's already a recovery in the Chinese economy. But that does not mean that they have the possibility of hitting any of these growth targets they've talked about before. And it's going to be very difficult for the party to walk away from these targets politically now.